Functions of a central bank. The modern banking system is two-tiered. This means that at the bottom there are commercial banks, the banks that we interact with on a day-to-day basis. They are then managed by a central bank which forms the next level in the hierarchy. The modern banking system provides central banks with considerably more rights and responsibilities. We will study the core functions that are performed by the modern-day central bank. The most important functions are as follows. Monopoly over issue of currency notes. Prior to the introduction of central banking, every bank could issue its own notes. As such, the economy would be flooded with thousands of different types of notes. The people accepting these notes would have very little idea of what the notes were worth or could be redeemed for. As such, there was less trust in the banking system as a whole. This is when the central banks took over. Central banks in modern times have been granted the sole right to print and distribute currency notes. The notes that they print are considered to be legal tender. This means that they are the only legally accepted form of money, and the courts will only enforce them if they are denominated in terms of the established legal tender. Therefore, modern-day central banks have monopoly over the issue of currency notes. They are in a position to ensure its acceptability and maintain its value without the intervention of competing market forces. Control over monetary policy. Central banks in today's world not only issue the currency notes, but they also determine the amount and timings of such currency issue. The modern-day monetary policy has virtually moved out of the realm of the government and into the realm of central banks. Central banks are supposed to be free of political influence. In theory, this means that they will not inflate or deflate the currency of the nation to meet political objectives. It is for this reason that governments all across the world have minimal influence on monetary policy. Rather, it is the central banks that decide the quantum of money and credit that circulates within the economy at any time. Bankers' Bank. The central bank provides stability to the financial system by controlling the actions of the commercial banks. The central bank does so by making it mandatory for commercial banks to have a certain percentage of their deposits maintained with itself. By controlling the amount of loans that the commercial bank can make and the way in which they manage their deposit, central banks can prevent mismanagement of funds by their subordinates. This puts them in a position to guarantee a portion of these deposits to general public, which creates confidence in the banking system. Lender of last resort. The central bank is considered to be the lender of last resort for all commercial banks under its domain. Many times banks face liquidity issues, and in such scenarios a run on the bank becomes inevitable. Without the help of a central bank, an individual bank will collapse in the event of a bank run. However, a central bank quickly pumps money as and when demanded by the depositors, reinforcing their confidence, averting the run, and keeping the system alive. Payment mechanism. Central banks have also made it possible to have a quick and efficient payment mechanism in the economy. This is because central banks have the ability to ensure that the payments made are irreversible and guaranteed. Thank you.